You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank global banking and markets leaders designed to provide you with timely insights and analysis. Mexico entered the pandemic already in a recession. Economic pressures from COVID-19, like severe drops in travel and tourism, have only exacerbated the problem. However, our new global reality has also created opportunities for growth in Mexico. Francisco Suarez, a director in global research at Scotiabank, joins me on this episode to discuss pain points and bright spots in the Mexican economy. Hi, Francisco. Thanks for joining us on the podcast today.
Thank you. My pleasure, Greg.
Mexico has a large portion of its economy based around travel and tourism. How has the sector been affected both from a domestic and international perspective?
What we see is that, for starters, it's going to be very hard for people to fly abroad, and not only because the Mexican currency has actually fallen quite dramatically, but also because at the end of the day, when you are able to have safe routes between regions or countries, you have to make sure that those countries can actually have the pandemic under control. So, for instance, now Europe, it bans Mexico, Brazil, and the United States for international travel. You have to be quarantined if you travel over there, and as well, if for some reason let's say consumers in the US or Canada wants to travel to the wonderful beaches that we have here in Mexico, perhaps they might be having second thoughts about not only about how the pandemic is handled here in Mexico, but also about the health system that operates here in Mexico. Perhaps they may be more comfortable to travel in their own country rather than to travel abroad. So yes, unfortunately, that hits a lot tourism in Mexico. And so, in that sense, we expect that domestic travelers will be actually leading the recovery in Mexico rather than international travelers coming to Mexico.
How are these shifts sort of financially affecting, or how do you anticipate them to financially affect the infrastructure operators?
Great question. We cover two types of infrastructure operators. The first group, the hardest hit, relates with the airport operators in Mexico. We see three different networks here in Mexico. One anchored by the Cancun airport in the southeast of Mexico. So that's basically tourism. But other networks relate more with business travel, and actually can actually do a little bit better off compared to that type of network. But if you see the difference between a toll road operator and a Mexican airport operator, the fact is that once that mobility restrictions from the pandemic are lifted, you start that mobility actually flows into the toll roads. So these type of operators can recover faster compared to what we see on Mexican airport operators in general. So I think that we have seen, for instance, in the past quarter, a 90% reduction in passenger traffic. I mean, in Mexico, we haven't made any restrictions for traveling, like in other countries, like Colombia, for instance, or in the Caribbean as well. But nevertheless, consumers and businesses alike choose not to travel. And so imagine it is a huge blow to overall revenues as such. Nevertheless, they were able to do a small operating profit in terms of EBITDA, which is actually quite remarkable considering that you lost 90% of your volumes. Uh, Toll roads are actually not doing that bad. They actually lost around 40% of their volumes. And of course, they are seeing much more better profits compared to Mexican airport operators.
In these concession agreements, are there backstops that are provided to the operators with respect to some kind of revenue protection?
Great question, Greg. Thank you. Basically, the overall regulation is very straightforward. It has been very business friendly, in my view, over the past 20 years, and it hasn't changed. What happens is that ultimately, if you are losing a lot of your passenger traffic, all the Mexican airport operators are able to amend their concessions in a way that they can actually cut their overall capital expenditures, and also they can also increase their tariffs that they charge to the passengers, for instance. And with that, the overall profitability can be restored. So yes, investors actually ask a lot of questions on the ability of the Mexican airport operators on how they will be able to restore the profitability even in these dire times.
So you have a general business friendly approach for concession agreement structuring, but have you seen any aftershocks as a result of the Mexico City airport project cancellation?
Yes, it affects more directly the overall construction activity in Mexico, since actually that cancellation happened. What happened before pre-COVID 19, we saw a decline, a double-digit decline in cement volumes, to give you an idea. So that means that the overall gross capital formation in Mexico has taken a toll since then, and we were in the middle of a recession back in 2019 because precisely of the lack of investment, because of the lack of clear visibility on what the new administration wanted. As you know, infrastructure requires a time horizon of roughly 25, 30 years. And when every time that you change the rules of the game, well, that takes a toll in new investments. So that has happened even before pre-COVID because of the cancellation of the Mexico City airport, the Mexico City airport. But and now we are seeing much more doubts in investment, particularly because of the changes in the energy sector as well. So that is taking a huge impact in overall construction activity in Mexico. Before COVID hit, actually one of the bright spots that we had was commercial real estate. That was going quite well, and that compensated a little bit all the cuts that we see elsewhere in other construction activity in Mexico. But now that COVID-19 hit, well, that will take a toll as well in commercial real estate.
As Mexico deals with this recession, are they going to be using new infrastructure projects as a tool to help revitalize construction, the economy in general? How is their approach compared to some of their regional peers?
Great question, Greg. For instance, if you take a look at Peru, well, the economy is going to be suffering as well a double-digit decline in GDP this year. But actually, the recovery is going to be quite fast according to their economists, and that is driven actually by by major pushes in infrastructure bills that account for roughly 11% of GDP. So it is a huge bill. The Peruvian economy is very solid in the sense that it has a very low debt as such, so they can afford it. And now they have the vehicles and the funding coming from abroad for that sort of infrastructure. Um, that is the case as well in Colombia, not as impressive as the 11% infrastructure bill that we are seeing in Peru. But in Colombia, we also see a lot of activity that is going to be spearheaded by construction of infrastructure, particularly toll roads. So that's very interesting. And unfortunately, here in Mexico, we are not seeing much of anything. The last um, the last figure that I have in my mind relates to roughly less than 1% of GDP, the potential bills that might be fueling the economy for the recovery. Having said that, over the next 3 weeks, the government announced in Mexico that they might be announcing a new energy related bill, and that may help a little bit things. But quite at this moment, the overall visibility on those is very limited in my view.
Turning to some of the things that you do see as positive stories in the Mexican economy, you've written extensively about industrial and commercial real estate. Can you break that down for us?
Well, e-commerce has been one of the most wonderful stories during the pandemic. And this is actually the case as well in Mexico as well, not only because the overall penetration of e-commerce in Mexico is relatively slow for Latin American standards, not to mention to developed markets, but also because we already see players listed in Mexico that have a lot of exposure to e-commerce. So you have players that are leasing space for the Amazons and the like. So yes, that has been fueling a lot of investments in commercial real estate, in industrial real estate. And the second reason why we are so optimistic about industrial real estate in Mexico is because the structural trends related with reshoring of light manufacturing production closer to the US, where the demand is, and make all the value chains more resilient. That was a major structural trend that was actually creating a lot of demand for industrial space in Mexico for light manufacturing. So this pandemic actually has reinforced these effects because all of a sudden a lot of industries suffer a lot of disruptions in their value chain. So after the pandemic, now we're seeing that all the players need to make sure that these supply chains can be much more resilient in any circumstances. And secondly, you have to bear in mind that we have the USMCA now into effect, and that is driving more investment from Asian investors that are trying to see that as an opportunity to keep their business alive, because they know that the USMCA requires a higher content of regional production in North America between Canada, US, and Mexico. And that is leaving aside the players that were based in Asia.
And what about retail and office? Are they struggling in the same way that the sectors are struggling all around the world?
Definitely, the hardest hit sector has been the retail sector. For instance, we have seen, and we are actually projecting a fall in net operating income for the players exposed to the retail industry in the 20 to 25% in nominal terms. So yes, that is a huge blow for that industry in particular. And this is not that is as bad in the office space. Yes, it depends because when you discuss these things with a CEO of Cisco, for instance, or anyone else involved in the teleworking value chain, they might tell you reasons why the office is dead. And when then you have the other extreme where certain landlords believe that nothing will happen and eventually the office will start to be quite packed again. I think that it is some sort of the middle. The solution that we see here is that is definitely we see much more flex work coming into place. The teleworking will be actually has been gaining a lot of share, and that is trend is going to continue. But having said that, I think that the name of the game is going to be flex work. So a combination between teleworking and going to the office, that is going to be the real trend. And in Mexico, we have seen that the office industry has been much more resilient compared to the retail space. So I think that ultimately it is about asset quality. That means having the right building for the new normal, namely the building has to be a good fit to have the flexibility that we might actually encourage for all landlords to be competitive, and perhaps as well about the overall well-being about the workers for that matter. That is what matters now, I believe.
For investors that are considering the sector, can you speak a little bit about the prevalence of US dollar denominated leases?
Yes, definitely. It might be awkward for a foreign investor, but uh, in Mexico, we have US dollar denominated leases. And the reason why we have that is that for the tenants involved in that particular building, they might actually be earning dollars as well. They may be in the value chain, on the export value chain for that matter. So that means that these tenants, they can actually afford to pay dollars even if they operate in Mexico, because their major market at the end of the day is in the US. So yes, investors can see some industrial real estate companies as an option, because they keep having a high share of US dollar denominated leases that helps them to keep their overall cost of capital down as well. And at the same time, what we have seen, for instance, in one name like Fibra Prologis, that name actually has preserved the overall value of the stock in when measured in dollars. So at the end of the day, you might see a nice safe haven in these players, because the nature of how much money they earn in US dollar denominated leases, and because at the end of the day, their overall underlying business is also growing at the same time, and they pay a lot of interesting dividends as well for the investor.
That was Francisco Suarez, Director in Global Research at Scotiabank. You can find more thought leading content from Scotiabank on our website at gbm.scotiabank.com, and you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. Thanks for listening.